merely trying to rope things into the tax deduction provisions merely for the purpose of collecting the taxes, but a larger and substantial disallowance can be made in terms of the provisions of 40A1A. In fact, we must jocularly admit, why I say jocularly admit is, one is because it's a practical joke, and two is because we need to have the courage to admit that when somebody comes to us and asks us about the requirement to deduct tax at source, almost invariably our first question is, are you the deductor? And if he says yes, then our answer is also yes, you must deduct. The reason being that any failure could lead to such drastic consequences, the consequences being so drastic that it is almost impossible for us to handle it at a later point. And as I was mentioning a little earlier, Section 40A1A is one of those provisions which makes the TDS provisions probably the most draconian of all provisions. Why at all should there be a disallowance when there are independent machineries for the recovery of taxes, etc.? If there is a failure to deduct is a larger question. But the fact remains that we do have a provision like 40A1A in the Act, and the fact also remains that given such a provision in the Act, we would have to advise our clients on the basis of the provisions as they are. We face two challenges. One is a challenge when it comes to preparing the tax audit report, where we have an obligation to report if there is a failure to deduct tax and if a disallowance therefore arises under 40A1A. And second is defending an assessee in assessment. I will probably start with 40A1A. I'll just touch on some of the issues relating to 40A1A and my thoughts on this, and then probably proceed to the other aspects relating to tax deduction at source. Now, talking of 40A1A itself, let me at the outset make myself clear that many of the points that I'm just about going to talk could be points where I may not be really advocating that anybody follow this or use one of what I am saying in relation to determining whether there is a requirement to deduct tax at source. But I would probably use this as a mechanism for defense in the event of an assessee getting into a problem with a failure to deduct tax at source, and as a result, the invocation of 40A1A. Now, the first of this is with regard to the amendment made by the Finance Act 2010. We will recall that 40A1A, as it stood when it was first introduced, provided that as regards payments which are there in the months starting from April to February of the previous year, you would have to make the payment of tax deduction deducted at source before March of the previous year. And as regards the payment of provision relating to March of the previous year, you had to pay before the due date. That is how it originally was for payment. It was thereafter amended to say it is enough if you pay within the due date for filing the return of income. And the Finance Act 2010, with retrospective effect from 2010-11, has clarified that this provision will apply even for payments or provisions made from April to February of the previous year. That means from assessment year 10-11, it is absolutely clear that an assessee who is required to deduct tax at source and where a disallowance could be invoked under 40A1A would have had sufficient compliance, and there would be a case for allowability if the tax deducted is remitted into the government account before the due date for filing the return of income. But prior to 10-11, the law as it then stood said for March you had time till the due date for filing the return. For April to February you had only time until the end of March of the previous year. Now, one first doubt that occurred to my mind is, would it be possible for us to argue that 40A1A, the amendment made by the Finance Act 2010, though it says it is operative from assessment year 10-11, is retrospective in operation from the time 40A1A came into force? Now, why this doubt came to my mind is, if we would recall the provisions of 43B in relation to employer contribution to employee welfare funds, we would recall that originally the provision stood that we had to remit the amounts before the due date stipulated in the relevant act, rule, notification or order. Whereas 43B was then amended to say it is enough if you pay by due date, and if you don't pay by due date, we will allow it in the previous year of claim, or in the previous year in which the payment is made. Though this amendment came by the Finance Act 2003 with effect from 1/4/2004, the Supreme Court in alum extrusions has held that this amendment, though stated to be with effect from 1/4/2004, is retrospective in operation. Can we take a similar plea? I am afraid we may not be able to, because of the simple reason that the Supreme Court, while interpreting 43B, took such a view for the reason that otherwise it would become discriminatory, in the sense that somebody who had, in say the financial year 1-2, delayed the payment of a contribution to a PF account by say 4 days would have had a disallowance in that year. But he has paid within the previous year. But in regard to somebody for 2001-2 who has not paid, and not at all paid until 2004, and in 2004 pays it, he will get it allowed in that year. So now we will find that somebody who has delayed by two days can have a disallowance, and somebody who delayed by 2 years can get the allowance. So it becomes discriminatory. Therefore, the Supreme Court probably arrived at this conclusion. I am not sure if we can take a similar view in the context of 40A1A. Now, once I am saying, or once I believe that such a view cannot be taken in the context of 40A1A, there are many other issues that come to my mind. The first of these is, what are the nature of payments which can attract a disallowance under 40A1A? We are all aware that 40A1A disallowance is attracted where there is a payment which warrants deduction under 194A, C, H, I or J. Leaving that aside for a moment, if we go to the opening clauses of section 40, it would start off with saying, notwithstanding anything contained in sections 30 to 38. In comparison, if we go to the provisions of 40 capital A, it would say, notwithstanding anything contained in any provisions of this act relating to the computation of income under the head profits and gains of business or profession. That means 40 capital A overrides 28 to 44, while 40 small a overrides only 30 to 36. 30 to 38, I am sorry. Therefore, if a payment, for example, is a claim of a deduction made under section 28, then that claim for deduction cannot be disallowed by virtue of 40 small a. I would not have a doubt on this for the simple reason that 40 small a only overrides 30 to 38 and not 28. Now a question arises, what expenditure would fall under 28 itself? There is a very nice decision of Supreme Court, probably then not very nice, but today nice because it helps us. The decision was in the context of 40 capital A3 in relation to cash payments, and the question before the Supreme Court was whether purchases would fall under 40A3. The Supreme Court went on to say purchases will fall under 40A3.